And we talked about it a lot.
I know.
We already talked about it a lot, but
Yeah.
that was a good conversation.
Yeah.
How about this? What was your mentality when you were going from like salary or whatever to
Yeah.
to strictly commission? Like, what were you feeling like?
So when I first started out,
Well, first of all,
yeah.
you want to do like an introduction? Let's do an introduction.
Yeah, that's fine.
Absolutely. Okay. So
Yeah.
so yeah, we just got here to the library,
Yeah.
and obviously we're high school
Yeah.
friends. Like,
Back.
yeah, we go way back. Yeah, we go absolutely way back. So it's like it's probably since middle school.
Yeah.
Yeah. So
Seriously.
yeah, a long time. So, but we both like Whit now. What do you do with?
Yeah. So I'm a mortgage loan officer
True.
with Garrison Capital Mortgage.
Solid.
Yeah, been doing it for about 2.5 years.
Oh, nice.
Worked for Chick-fil-A for a very long time,
Right.
and just was interested in real estate in general, but
True.
the financial side of it.
Yeah.
So jumped in head first and have been doing it ever since. So,
It really took off for you. It really,
yeah, it's been good.
That's good.
Despite the market,
right? Despite the
I was
market.
telling you earlier, like the first pre-approval I ever gave had a 2.5% interest rate on it, and it's like that quickly disappeared.
Right. You just started 2.5 years ago, and then like in a matter of,
and then the market just
flipped on its head.
Rates skyrocketed. Yeah. So, yeah. So when I first started out, I was kind of in a different position and was salaried plus commission, which was like kind of a better gig for just getting in, you know. But yeah, I think no matter what industry you're in, when it's full commission, it's always nerve-wracking in the beginning, especially when you being in real estate, like you can't control what the real estate market does, just like I can't control interest rates.
Right. You gotta go with the market. You absolutely
gotta go with it. So I think, for anyone wanting to like get into either industry, it's like, I think being focused on budgeting and like your own personal finances, it goes hand in hand with being in commission-based job. So
you think most people have a money management problem more than a income?
Oh, without a doubt.
Right.
Without a doubt. I think, I don't know what the stats are now, but even a few years back, it was 70% of Americans were living paycheck to paycheck.
Absolutely. I think it's even more now.
Yeah. Credit card debt is all-time high. Student loan debt's at all-time high. Right. So you think about those aspects, like, it's 100% a money management issue. But we've said this a couple of times already. You don't know what you don't know.
You don't know what you don't know.
Yeah. So I mean, my background, I was not taught anything about money. So I think that's kind of what got me into. That's what I was about to say. Industry.
What got you into? Was it?
Yeah. So I had said like my time at Chick-fil-A. One thing, me and another guy sat down, we would talk about just budgeting, finances, investing, and we started like asking high school kids and college kids, like, hey, how are you paying for school? That was the $1 million question.
Wow,
like,
what a good
okay,
question.
If you're going to take out loans, let's talk about what that looks like. Like, have you ever heard, I would ask the question, have you ever heard of compounding interest? Like, do you know how much your dollar is worth at 20 years old versus at 40? Right.
And if you when you get started, and how much it makes a difference.
You get started at 20 years old, it's $88. That dollar's worth $88. So being able to like educate kids, like,
go into that a little deeper. What is it?
And I'm not a CFP. Like, this is all just
okay. So we'll keep on going. I see it.
But I mean, the main thing being like, anybody can do it. You just have to, you got to know what you're doing when it comes to, I felt like the lack of education around finances in general, but specifically retirement. We were all fed like, got to go to college, got to take out loans.
Then what?
Yeah, then what?
Right, absolutely. How are you going to pay these things?
How are you going to pay it back? I think like that's where I started to kind of realize I had a passion for educating, specifically high school and college kids, because that was me. Like we both went to high school and college and I didn't know anything about money. at Chick-fil-A, me and another guy, we helped kids set up Roth IRAs, really helped them think through like, hey, maybe you should go to like a local community college for 2 years and then transfer to where you want to go.
Great advice.
Like you're going to save so much money.
You will.
Compared to going to 4-year school.
Right. Especially because you get like community colleges provide a really good value.
Yeah.
Just because in the first 2 years you're doing all general education courses, so you can save a ton of money.
And you're paying nothing compared to
a university.
At a university.
And the universities are good. I don't want to knock them, but
yeah, absolutely. If you can pay for it.
If you can pay for it, you can afford it. But
absolutely.
Community college there's nothing wrong with it.
Yeah.
I mean, I was fortunate to go to a 4-year university, but I definitely see the value in just how it could just give you the opportunity and time to really focus on find what you want to do.
What you want to do.
Because in that time, you could decide that you want to go off and start a business or whatever the case
or get into real estate.
You want to get into real estate or whatever it is. Yeah. Like get started in real estate super early. So like that's a great idea.
Yeah. Honestly, so that kind of transitioned into this job. I got pitched, a job offer to start with some real estate agents as a loan officer. And I just got in at the right time and have learned. Holy smokes, have I learned.
Yeah.
A lot.
So and they really happen to grow even during this down, like what people a lot of times will say is like, oh, it seems like real estate's not doing well, or like, houses, it's not a great time to buy a house right now, but it seems your company actually grew throughout this time.
Yeah, we really have. Yeah. So, I mean, and that's part of like just maintaining realtor relationships. It's like you and I've said today as well, is like people will always have to buy houses.
They're always going to have to buy a house,
no matter what the state of the market is. And data shows that in 21, 6 million houses were sold. In 22, I think it was 5.5, and this year it's on pace to be 4.5. It's like that's a huge swing.
It is. It's a big swing.
It's a huge swing. But I think what you and I do in this time to grow our business, to focus on building relationships, to focus on bringing value to our clients and our partners that we work with. If you can weather the storm,
through these cold months.
Yes.
When it gets to be summer or even spring of next year, like when people are ready to buy, you want to really get ahead of the game. Like you don't want to be getting your ducks in a row in March when everyone is looking to buy, because people are looking to buy right now. There's plenty of people that are looking to buy. Like we were talking about earlier, this fourth quarter has been the busiest month.
Yeah, it's been insane.
Talk about
I
that's insane.
I don't know. You build your pipeline and you try to look into the future as much as possible.
Right.
And like the way real estate goes, it's like you're slow. Fall is always going to be slower than spring.
Right.
December and January are always going to be lighter months.
Right.
You're coming out of the holidays. A lot of times people think it's crazy to list a house in the middle of December between Thanksgiving and I think in our industry, like people take their foot off the gas. Whether it does make sense, but if you're a buyer right now, I think your time to buy a house, and this is a personal opinion, okay? You have to be very careful with what you say and how you educate people. But I mean, I'll give you an example. I had a client within the last week go under contract on a house. They were about to submit an offer, and they were going to submit a very competitive offer. And the buyer's agent called the list agent to be like, hey, just want to check in, see if there's any offers. Like we're probably going to submit an offer. And they checked in, and the listing agent was like, no other offers. This is in the west end of Richmond.
Wow.
Now we're approaching Thanksgiving, December,
Holidays,
things tend to slow down during that time anyway. But you also had the marathon was that weekend. So maybe people chilled out on that open house or whatnot. So they were going to offer $40,000 over list price.
Wow.
And they got it for like $33,000 less than what they were going to offer.
70K swing.
Like
that's good.
I mean,
well, interesting.
Like, so from the buyer's standpoint, it's like they were able to I have not seen that happen like very much in the last 2 years, where buyers are able to capitalize. And I think we're seeing more seller concessions, people doing things like 2-1 buy downs, right? Like, and I don't think we'll see a full-fledged swing back into a buyer's market, but I think like the next month and a half to 2 months, if you're interested in buying a house, now is probably the better time out of the next 10 to 12 months to maybe capitalize.
Yeah. What about like for people who already have homes? Like, what are their loan options? Like, because I know sometimes you can get a 3.5% loan, even though you already have a home loan, like a 104.3C.
The main things that I'm seeing right now, you're seeing loan assumptions. Like if you have a FHA or VA loan, being able to list your house, it doesn't really help you for your next house if you're a list agent, but can be a huge incentive to sell that house.
Okay.
Loan assumption is most popular with VA loans.
Okay.
Where like the buyer gets to assume your loan terms, right? They pick up where you left off. They get to keep that good interest rate.
Where the buyer.
So I've seen that has been a huge kind of perk to draw buyers in. I think kind of the hacks that we've seen with this doesn't help listing or sellers with interest rates, but being able to buy now and then sell your house, right? That like we saw this a lot over the last 2 years where the market is so crazy. What are you going to do if you own a house and you want to sell? Like, you're not getting a contingent offer accepted right now, right? Like contingent on the sale of your home. So what do? Do you sell your house and live in an Airbnb? But then you run the risk of like, what happens if you don't find a house? Like there's so many things.
That's a huge fear for a lot of people, what to do in that gap, in that transition.
So I'm sure like on the real estate side, you saw rent backs were huge, where you sell your house and you get a free rent back for 60 days for an additional 60 days after closing. On the loan side, what we pushed and we had quite a few people do is called a recast. I like to call it a delayed. That is NASCAR going on right here.
Yeah. I was getting it.
So recast is, I like to call it a delayed down payment.
Okay.
Not all lenders offer it. It totally depends on who ends up servicing your loan. Is you're re-amortizing your loan. And so let me play out the scenario that you would use a recast. You currently own a home, and you're like, do I need to sell it to be able to buy? If you can float both mortgages, right, for a new house and keep this one, what you can do is you can actually buy your new house, put the minimum down, and then sell your house. Now, let's say in this example, you have $200,000 in equity that you just earned from the sale of your house. You're like, I want to put this down as my down payment, but I don't have it yet, right? Because I haven't sold my house. So you've bought, now you sell, you have this $200,000. Instead of refinancing, which you have to repay closing costs, you're going to get a new interest rate. You can do what's called a recast, and you take that $200,000 and you're going to chuck it at your principal, right?
Yeah.
But it's going to re-amortize your loan to where that actually lowers your down payment.
Absolutely.
So that's why I really, in layman's terms, I say it's a delayed down payment. So not every lender will do it. It really, really depends.
It doesn't require you to utilize you get 200 that whole $200,000 in equity, or could you use 150 or a portion of it?
And do whatever you want.
Interesting.
Yeah, and the other thing too is a recast is not just for this specific scenario. I've told other people as well, like a lot of times, like on these podcasts and stuff that you're listening to about real estate, of like or finances in general, like you want to pay off your house faster, here's ways to do it. A lot of times people, let's say you inherit 10 grand from grandma or something like that, and you want to pay that $10,000 towards your principal. A lot of times what people will do is they'll just pay it on their next payment, they'll just pay an additional $10,000. But your next payment the following month, is still going to be the same.
The same mortgage
right?
payment, right?
So with a recast, though, you're kind of going behind it to where you're buying down the principal, and it actually restructures your loan payments to lower your monthly payment.
Nice.
So
that's
whether you're doing it in the scenario where you just sold your house, you have $200,000, you want to throw 150, 200,000 at it, or you get 10 grand from grandma and you want to just buy down your principal. Exactly.
Right.
Lowers your monthly payments.
Absolutely. Solid.
Yeah. So that's a huge hack.
Garrison.
Capital. Yeah. So we're a mortgage brokerage. So we have access to around 7 wholesale lenders that we work with.
Sure.
And 3 or 4 of them allow recasting.
Okay, cool.
So when I first got in, they did not.
And just over this course of 2 years.
Nice. So and they all have different kind of requirements. Some you have to make at least 1 to 3 payments.
Awesome. That's good stuff. That was good. Like that recast.
Recast. Awesome.
Yeah. No, that's cool. On the real estate side, I think a lot of things that I run into are most people are worried about financing. Like that is their biggest hiccup, and for a lot of people. So, one thing we were talking about earlier is a guy who had 10,000, like he has a down payment amount, and his wife makes the income or whatever, and that's fine. But they're a little hesitant to start buying, or start the process. And I think there's many different ways to get past that. I think that's something a lot of people face, and you can either start building your credit, loan options. Like she doesn't have to be on the loan. He doesn't have to be on the loan.
Absolutely, he does not.
And there's probably more options.
There's a lot of options out there.
Situation, but it shouldn't really hinder someone. What made you're a homeowner. What made you get a house at like 20? When did you get a home?
I was 28.
Nice.
I'll tell you this.
Still a very young age.
I rented with 3 other guys post college.
Wow.
And you don't know what you don't know.
Right.
And it's always hindsight 2020.
That's a smart idea though, to cut down on calls for sure.
It's not. I should have bought the house and rented to those 3 guys.
Now that's the smartest move.
Yeah. But you don't know what you don't know.
You don't know what you don't know.
And I think too, like if you've never bought a house,
right,
and you're in your early to mid, either late 20s, early 30s, it can be so intimidating that you think like, oh, I got to save 20% down. I got to have X amount of dollars.
Absolutely.
And it is not true.
It's not true.
Right? Like,
but you don't know.
You don't know what you don't know. So, I mean, I think for me in my early 20s, I just assumed like, maybe I'll buy a house one day.
Right.
And
like one day, whenever,
like a long time from now,
right. After I work
a long time and save a bunch of money and yada yada yada. But I got married, and that was our number one goal.
Get a house, nice,
And so we bought fairly quickly after getting married, and we bought as interest rates in that spring of 22 as they were skyrocketing.
Sure.
And so. Yeah, I mean, it had been a goal of mine for a while at that point. But with getting married, we didn't know where we were going to be. So that, we didn't want to buy a house somewhere and then end up working in different areas. And so we waited till the time was right. And we're able to capitalize on a good house.
Nice.
So, I mean, again, if I knew what I know now, I would have bought a house in 2016,
just years ago.
So, but there's so many options and products out there, especially for first-time home buyers. I think a lot of times what we'll talk about in first-time home buyer seminars and stuff is like, what are the biggest misconceptions in real estate, right? Like, what are the things that people think they know that they are most likely have a misconception about? And the biggest one is down payment. I have to save 20% to be able to buy a house, and it's not true whatsoever.
How often do you see that first time? How often do you see a first-time home buyer put down 20%? Like,
oh gosh, hardly ever.
Right?
I mean, honestly, are you familiar with Dave Ramsey at all?
Absolutely.
I don't agree with everything Dave Ramsey says, but like, that's kind of what got me into at least like researching finances and like what do I want to do about retirement. And he forever was 20% down or die. Like
he really stood firm by that.
And now he's 5%.
Yeah,
he's pivoted, because it's not like the people who are putting 20% down, either they're getting a drastic gift from someone typically, or you have equity in a house that you previously bought, right? So like those are the people putting 20% down. Like either you're getting a gift or you're selling a house that you have equity in. So
and there's all sorts of options for
so I mean 3% down, Fannie Freddie conventional loans, 3% down for first time home buyers. And it's a great product. And we actually have access to, it's insane. I can't believe this product exists right now. I don't think it will stay around forever. But it's a, you can either do a 5% down or a 3% down loan. And the lender will give you a 2% grant towards your down payment. You don't have to pay it back. It doesn't have to be in the census tract. It can be anywhere in the state of Virginia. There are some caveats. It has to be under $350,000 loan. You have to make less than $87,000 in Richmond. It's based on the 80% area median income. Sure. So in Metro Richmond, that's around $87,250. And yeah, it's insane. Now, on top of a 2% grant towards your down payment, there's no PMI. What is PMI? That is private mortgage insurance. Absolutely. Exactly. Sure. So where the misconception for 20% comes from is on a conventional loan, if you put less than 20% down, you're going to pay what's called PMI, private mortgage insurance, and you're going to pay that until you own 20% of your house. Okay? So in this case, you're getting a 2% grant towards your down payment and then no PMI. So that is going to save you on your monthly payment at least a couple $100 a month. Yeah. It's a huge product. So there are things out there that are sitting there on a silver platter for first-time home buyers. So I mean, some of the other like products out there for first-time home buyers, you can do a DPA program, down payment assistance program. So you can finance your down payment. It's not the best terms, like you're going to pay a higher interest rate and it's positioned as a second lien on your house. So
this is separate than one of the, I guess, government funded down payment assistance programs.
Yeah. So most of the DPA programs are through FHA, which is government, Federal Housing Administration. So it's a good product for someone who just doesn't have a lot of cash on hand, right? Like you might be fine with the monthly payment. You might be fine, with your current income. You might just not have a lot of cash on hand right now. And so it's a way that you can get into a house without
going into your own pocket.
Yeah, going into your own pocket. Right. Yeah. And so, most of the time when people elect to do a DPA program, they end up refinancing within a few years. So that way they're not getting hosed on that second mortgage for the life of the, all 30 years. Yeah. So there's so many different tips and tricks and hacks. And, my biggest piece of advice is if you're even remotely interested in potentially buying a house, I would say in the next 10 years, you should talk to a real estate agent and a mortgage loan professional.
I know a real estate agent.
Yeah, I know a pretty good one.
Yeah.
I mean, I think that I wish we could scream it from the rooftops. Because you might be 5 years out from buying a house, but like if you start game planning today, you're going to hit your goals so much faster.
Very soon.
Yeah,
absolutely.
You'll be able to.
And you'll look back and you will be happy that you bought a house. Like the only people I've come in contact with that have been upset with their home purchase right now are people that have moved out of state. Well, no one has been upset. The only reason they've sold is because they had to move out of state. Yeah. And but everyone I talked to that owns a home is very satisfied that they even bought when they did. And so, people that I've worked with now are excited to buy a home. So,
I mean, dude, I'll tell you, I was nervous to buy my house.
So was that. It's a huge purchase.
It's a huge purchase. It's arguably the biggest purchase most of us will ever make in our life. Right. And with where rates were at, like I kind of got in at the 4.5 to 5 range for interest rates, and like I was terrified because rates had been at 2.5. Like, so you're thinking I'm getting double what it's been at, and now we're in high 7s, 8s. It's like hindsight is always 20/20, and so now I'm like, thank God I bought when I did. But at the time, I was like, what if rates cap out at 5% and never go back? So. I think like we've said it, but people will always have to buy houses.
Right.
And I think like as time goes on, we're going to see the people jump back in that are like, well, I've been waiting. I've been waiting for rates to drop, or I've been waiting for house prices to go down. And they're going to realize like, in some cases, depending on what you're waiting on, you might wait forever.
You might wait.
Right?
If you're thinking it's going to go back down to like, 220. I mean, I'm not the one to say it will never go back down to like $150 for like these houses, but you're gonna be hard pressed to find in the Richmond area, a 4-bed, 3-bath for
you might
180.
You might be able to go to Portland or some of these other places that the housing market is kind of tanking right now and find a good deal. Right. But Richmond, people are flocking here, man.
People are flocking here. I talked to a bunch of people that are moving down here from DC, down here from Philadelphia, Pennsylvania, New York even. And so people are coming down here because there are a lot of houses. Like the growth in Richmond is really here.
Yeah, it's awesome. I don't know, man. We definitely have a supply and demand issue.
We do,
and we'll continue to have that for a while. But that's good. That's good. Like, it's not good for everyone, but I think it is good for our market that people want to be here.
People want to be here, but some people can't. It's interesting. Let's talk about it. It's a tough topic. Okay.
Yeah.
So let's talk about like maybe the median home price. So like let's talk about our home area, right?
Yeah.
Say 700,000. Median average household in Goochland. About 750,000, 700,000. So, do you think that makes it tough, or that's just it is what it is? Like, what do you think?
Yeah, I think it makes it tough. I think Goochland. It's funny because we're both from Goochland, so like we have a unique perspective,
right? Because we know it's a great place and a wonderful place to be. So it's
I think Goochland is such an anomaly in our market because. I have a lot of friends in Amelia, right? So west of Chesterfield. Right. So it's like you've seen in the last 10 years Magnolia Green pop up. It's growing west, right?
Right.
Absolutely. Same thing. Richmond and Henrico. West End is growing west, right? I think what makes Goochland such a hot, focal point on the map is 64, right? So if you chuck Powhatan in there, and Amelia, and Dinwiddie, even Hanover, they don't have 64 cutting through them the way that Goochland does,
and even 288.
Even 288, you have the interchange is there, and it's like if you commute to Charlottesville, or you commute to Richmond, Goochland, depending on where you're at, you're smack dab in the middle.
Smack in the middle.
And so I think being in that community, living in that community, I think people who have lived in Goochland for a majority of their life, I think are scared. They're scared. It's coming. It's coming. Henrico West End is growing to Richmond. But my argument, if I'm non-biased, right?
Sure. Okay.
Non-biased, it's inevitable.
Right. Oh,
it's inevitable. That it has to grow that way, because if you look around the West End in Metro Richmond, which way is it going? It's growing up, right? They're building condos, they're building townhouses, apartments, Scott's Addition. Everything it has to go this way because there's no more. There's not a lot of land.
It's no more. You have to go vertical.
You have to go vertical, and so I think I don't know if you were familiar with it, but there's been a lot of chaos over the last year with them trying to push through a 40 home development in Goochland, like fairgrounds area, and like people are not stoked about it. They're talking about how like if you chuck 40 homes in there, have 80 cars commuting on Fairgrounds Road now, what is that going to do to the infrastructure? Like you're gonna have to widen the road. You're gonna have to put in more roundabouts. You're gonna have to like do it. And my thing there is, growing up before Food Lion came into like downtown Goochland, there was this little country store called Town and Country.
Absolutely.
That's where people went to the grocery
the
store.
Only grocery store,
right? And so I know when they talked about putting Food Lion in, everyone was like, "You're gonna put Town and Country out of business," and I think my statement is the same. It's inevitable. Like as people continue to move to Richmond, it has to grow. North, south, east, and west. And west with 64, Goochland is going to be a hot topic.
Right, especially going straight to Charlottesville, UVA, all the stuff.
Yeah,
and then everywhere though it has been growing. But I can see definitely corridor like Ashland is obviously growing. Yeah, that's a hot area over there. New Kent, New Kent's a really nice area. Yeah, that's
really is.
And then Chesterfield. Like, what do you think? Like, Goochland is obviously the nicest.
Yeah, I mean, we're just biased to Goochland because we grew up there.
Absolutely.
And I live there now.
Yeah. See, I live in, I definitely can know that. Yeah. But I do live in Richmond. I live in Richmond now.
Yeah.
And I think the difference between like living in Richmond and like living in Goochland, growing up in Goochland, it's nice to be like, if you're like a person who likes, to go to restaurants or like just to go, be close to what's going on.
Yeah.
Or whatever, that hustle and bustle. And I used to work downtown. Yeah. So it was just nice being down there. But I think, when you grow and you have a family and, you want to give them an experience of outdoors and just like real living, I guess.
Yeah.
Like, city living is nice too, depending on your mojo. But
I mean, to what you're saying, like, I think every single generation, this is how it goes, right? Like, you grow up in the suburbs.
Right.
And then you move to the city. That's what you want to do when you're in your 20s, right? Like, that's where things are happening. Like, whether it's, I can't, like, if we had known when we were young that Scott's Addition would be Scott's Addition, we would have all bought podunk abandoned buildings 10 years ago.
and made them warehouse, nice warehouse apartments. They're super nice down there.
Yeah, and so I think like, and then it goes in a circle. Like once you get married, you want to settle down. What do? You move to the suburbs. And I think like I had an econ professor in college who talked about it. And he was like, he was in his 80s when I had him. He had like flipped businesses. He had been in the military and he was fascinating. But he said like the third time that he saw the fan blow up, he was like, I finally bought real estate. And he ended up selling property to VCU as VCU is growing. So, he bought it pennies on the dollar when everyone was leaving the fan and then flipped it and sold it to VCU, 20 years later. So, he was saying it. He saw it every generation. Like you have the 20-year-olds move to the fan, and then when they settle down, they move to the suburbs.
Right.
And so, like, I think that's not true for everyone, but I think generalization.
The generalization, a very good, accurate generalization for a lot of families.
For some trends,
right? Yeah. I think if I were to look at my situation, I'm currently in the city, and I want to move, closer to a more rural area. What do you think, as far as you go with like, you think it's nice being away, out there? Or would you ever? How about this? Let's talk about this actually. What about as far as investment strategies?
Yeah, I want to talk about this. Huh? Yeah. I said I wanted to talk about investment.
As far as investment strategies, like what do you think for someone who's just getting started out, right? What would be, because you talk about real estate, you talk about crypto, you talk about stocks. Like what? There's so many. So what do you think would be a solid foot in the door?
I think I'll use myself as an example. Right. Like if I was in my early 20s, like what am I doing today?
Right. What would you do? Yeah.
I think the best hack out there right now, for single people, if you are married, like, I know some married people who are doing this as well, but I say single just because, once you get married and you start to have a growing family, you don't want to, like, it gets more difficult to move, right? But this strategy, what people don't know is when you buy a house with a loan, that, and you're going to live there, that's your primary residence. So you're getting, your loan is going to say that it's your primary residence.
Right.
Now, you fulfill what's called your occupancy requirement after living there for 12 months.
Sure.
Okay, so if you buy a
primary... And that's if you don't have a set down payment. This isn't sort of a locked...
No, this is it. It's locked. Right. Yep. This is your primary residence, and you got a primary interest rate, sure, right? Where if I were today to go buy an investment property, right, that means I'm not living there. I'm solely buying it to rent it out. You're going to get a worse interest rate, right? Absolutely. So the occupancy requirement on that loan is investment. So when you buy a primary residence, once you live there for 12 months, you fulfill that occupancy requirement. So what does that mean? That means you can now go buy another primary residence and rent out the other house.
Right.
Okay? Now,
real quick.
Yeah, go ahead.
Can someone do this with a 3.5% down payment?
Absolutely.
Okay.
So you buy your first house. We'll say conventional.
Sure. We'll say let's use conventional.
Let's do conventional as an example. Right. So you're a first-time home buyer. You don't own a house. You want to buy your first house. You put 3% down. Right. You live there for 12 months. Right. All right. At the 11-month mark, you get pre-approved again. Okay. You start shopping, and you go buy another primary residence. What's the minimum down payment for a primary residence now that you own a house? 5%. 5%. Where if you bought your first house, 3% down, 3%. You live there, and you're like, oh, I want to buy property in, the East End, right? I want to buy an investment property. You're going to put 20 or 25% down, right? So the amount of time that's going to take you to save up that
25%.
Yeah. To buy an investment property, right? Now, so what you do instead is you buy another primary residence and rent the other one out. The first one out.
Satisfied that occupancy.
Yeah. Nice. So what do you do 11 months later? You do it again. So it's repeat, right? Yeah, it's a little more volatile right now with rates being high. Like, I still have clients doing this, but you're not seeing it as much just because, if depending on where your payment is at with putting 3.5% down, and what your interest rate was, you may not be able to cover the whole cost. But I mean, even then, people are still doing it, and I think it is the biggest hack. I'll add this hack on it because this is big news that came out. Yeah. So we're going to talk about duplex, right? Yeah. Multi-unit. So 2 to 4 unit homes. Yep. So over the past 2 years, I probably have had 3 or 4 clients buy duplex, and they live in one side and they rent the other side out.
Okay, a lot of people are curious about that.
Yep. So the way that people would do it is you would actually use an FHA loan. Why do FHA instead of conventional?
Right.
For a multi-unit, if you're going to live in one side and rent out the other units, for FHA, it's 3.5% down, whether it was 1 to 4 units.
Right.
Always 3.5%. Yep. So that's with FHA. With conventional, once you got to 2 units, you had to put 15% down, even if you were going to live in it.
Quite a difference.
Yep.
Right?
Yeah, that's a lot. If you got up to 3 or 4 units, it's 25% down. So the hack is, or was, you would do FHA because you get to buy a 2, 3, or 4 unit house and only put 3.5% down, and then you get to freaking rent out the rest of them, right? So I had 2 clients do this, and then they hit their 12 months and they're like, hey, I want to do it again. I want to buy another duplex, right? Live in that one primary,
right,
and rent out the other side
while the other two
are being rented out. Okay. Exactly. Yeah. So what we ran into is you can only have one FHA loan, right?
That's running out.
Yes. Now there's like 4 different scenarios. Like if you're moving out of state, or if you're there's different reasons that you could qualify for 2 FHA loans. But for your general, I'm moving to buy another house, and especially for investment purposes, you're not going to get a second FHA loan. Yeah. So what we were running into is now we're telling these investors, like savvy young guys and girls who are trying to do this house hack, is like, now you got to put 15% down if you want to buy another duplex. So coming out this in the last like 2 weeks, Fannie Freddie, conventional, they're the two government sponsored enterprises that back conventional loans. They are the ones that create the guidelines for conventional loans. Fannie Freddie, absolutely. And they announced that they have changed it, and now you can buy a 2, 3, or 4 unit primary residence for 5% down. So that's a huge deal. Yeah,
that's a huge deal. And I don't think a lot of people know that, because people are probably under the assumption that you have to, when you want to get your second investment property, like, well, maybe even your first, you will need to put 25%
down. Exactly. So this is why, like, people who are interested in investing, and I keep on saying single, you don't have to be single. I just mean, like, once you have a family, like I have a daughter now, I'm not moving once a year. Like, it just wouldn't fit for my lifestyle right now.
It would be really tough.
It'd be really tough.
What would be an investment strategy for a person with a family who wanted to get into something like that wouldn't necessarily be able to occupy the second residency, like, maintain or obtain occupancy for that second residency?
Yeah, that's a good question. Again, you're not seeing a ton of right now because of where rates are. So like putting 25% down, buying a property, and then getting that monthly payment with where that rate is, a lot of times it's hard to cash flow right this second. But
that's a realistic answer. I think people are going to appreciate that, like right this second.
Yeah,
but
some people are still doing it. But I think you asked me what's the strategy if I own and I want to buy an investment property. If you've owned a house for over 2 years, if you bought in 21 or before, then you most likely have a decent chunk of equity in your house. Right. So what would I do if I bought a house pre 2021? Here's what I'm doing. I'm taking out a HELOC. What's a HELOC? It's a home equity line of credit. Okay, so you can take a certain percentage of the equity out of your house, and it's essentially set up like a credit card, right? You don't have to tap into it right away. Once you do, you're going to pay interest on it until you pay it off. So you get a HELOC, right?
And this is a large sum of money.
It's a large sum of money.
Absolutely.
Right? So let's say, like, my HELOC, based on the equity that I have in my house, I have $200,000 in my HELOC that I can tap into, right? I'm tapping into the equity in my home.
This is based off of your credit.
Correct.
The amount that you
get. The amount, yes, exactly. So now I've got this home equity line of credit. What people do is they will buy a cheaper, more distressed property, okay? And they're going to pay cash for it. And when I say cash, you're using the money from your HELOC, from your home equity line of credit. So you take that 200, let's say you find a house off market, it's a crap hole and needs a lot to be fixed up. You buy it for, let's say you get it for 125 grand. You fix it up, you put time and effort into it, and you can then do what's called a cash out refinance. Okay, which is, so there's no loan on the $125,000 house that you bought, right? So you paid cash from your home equity line of credit to get that house. Now you fixed it up, right? You redid the floors, you redid the roof. Maybe maybe it had like a loft and you converted that into a room. You added some square footage to it.
Added value to it. Nice.
Added value to it. Now you're going to do a cash out refinance. Most cash out refis, you can take 80% of the value that it appraises for out. And so let's say it appraises for $250,000. Now you get to take your 125 out and you pay your HELOC off. You put the money back. So now what? Now you own another investment property. Like you own another home that you essentially didn't really pay for because you tapped into the equity in your current home and you utilized and leveraged the equity by bringing value to this, $125,000 home. to be able to pull the money back out and pay the HELOC off. So I will say there's a tidbit that I think, this is called the BRRRR method. Are you familiar with the BRRRR method at all? Buy, rehab,
rinse,
rent,
repeat,
refinance, repeat.
Uh-huh.
So that's the BRRRR method. I will say what happened I think it was in March, this got implemented. So it used to be you could do a cash out refinance. You had to own the property for 6 months. So in this example that we're using, you take the money out of your HELOC, you buy the house. You can't you can't do a cash out refi for 6 months. Okay. It is still 6 months as long as you pay cash for the house, which in this example, you would have.
Because you used your HELOC.
So if you, let's say you buy that $125,000 property with a loan, right? And you're doing the same thing. You're going to fix it up and you're going to do a cash out refi. And, you know, if you have any sort of loan on a property, the new guidelines are you have to sit on it for 12 months. So some people call it the BRRRR killer. It's like if you're using money to leverage and but you're still taking a loan,
you got to take a year off. Pretty
Yeah,
much.
you got to take a year off. So that, like, I have had investors like, you know, who found the BRRRR strategy via Bigger Pockets podcast and like other things, who never picked up that you had to wait any time to cash out refi. Let alone if you took a loan out, now you have to wait a year,
a whole 12
months. So that, like, do your research.
That could really, you know, put you.
It could really damper. Yeah. So,
because you know, a lot of people do think it is a nice, it is appealing, you know.
Yeah. It is. It sounds good, and it's all bright and shiny.
There's stuff that goes into it.
Yeah. And people are still doing it. You know, but like the people I've run into who are really buying investment properties, they have a bunch of money that they're like, I kind of need to offload it somewhere, right? So I'm going to buy an investment property and I'm going to break even on renting it until I can refinance. Like once rates come down some, they'll refi. Those are typically the people I've seen most buying who are using loans right now.
So when people go out and buy, you found like most people obviously buy, well, not obviously, but people buy with loans, like people buy with credit. Like yeah, absolutely, right? Like that's how you get a house. Most though. There are people that, you know.
Yeah, there's anomalies.
Yeah,
always.
Yeah, absolutely, but that's how it works, though.
Yeah,
like I think that's really important to know. I think most people are starting to understand the value and importance of, you know, credit.
Yeah.
And the power of credit, because if you have great credit, you can go out and it's a bunch of stuff you have access to. So do you have recommendations for people like who want to fix their credit? Like, do you help people with that? Or if they want to get started, like, what would you say?
There's a couple of people that I work with who handle like credit repair. We have with a couple lenders that we have, the range that most wholesale lenders are going to be is 620 or above. Some cases they might squeeze you in at 650, but I think majority are going to be 620 or above. And so a couple of the lenders that we work with.
So you're saying for most of the lenders that you all work with, they want you to come in the door with a 620 or above. That's kind of the bare minimum.
Yep.
I think that's attainable for a lot of people.
Yeah. Absolutely. And so we have one of the lenders specifically that I work with have this great resource where you can actually run different credit scenarios. So let's say you're at 610, right? And the minimum 620, right? This specific lender will actually run different scenarios to be like, hey, if you pay off this or you just do X, Y, or Z, it'll increase your score by 40 points overnight. Like, and that, like, we have had people actually not qualify, and then we run them through this, you know, quick system, and is like, hey, pay off this $50 debt, and then they'll do what's called a credit supplement with that specific creditor, and then it bumps their score up. So there's absolutely ways,
a ton of ways
to be able to do it.
Cool. Good to know. Absolutely.
Yeah, really, and there's credit repair companies like that. You know, there's a few that I've talked to before. Like, if you're way below guidance on how to do that, there are people out there that you can use as a resource to like figure out, come up with a game plan to like, because if you're not educated on credit, it's easy to like.
It's really easy to get yourself
get into the hole and like it's hard to dig out of it.
It's hard to dig yourself out.
Yeah.
And like I think the process for people who are like looking to get out of a hole in credit, like you really should probably talk to somebody, and then because there are people that can help, and then it makes the process to get like once you get your credit right, then you can get a home, and then you can really start going on that side of the scale where you're just building equity, and then you can tap into your good credit, your good, all that stuff. So it's a real
absolutely. And I mean I think too, like this kind of goes hand in hand with credit. Like these are things that we were not taught. I think it is very important for people to know. I'm going to go down the self-employed rabbit hole for a minute.
Let's talk about that. How important is credit being self-employed? Or even in general?
It's equally as important. The thing with self-employed is it's variable income, right? So you're going to have typically 2 years of tax returns, filed tax returns, to be able to use that as qualifying income when getting pre-approved or getting a loan to buy a house.
So if you don't have 2 years work experience or consistent paychecks, payroll coming in, it's hard for you to get a loan.
Well, even if you have consistent income, if you don't file your taxes, then now you don't, because it's not on paper. So that's what I really want to reference. I've run into it before, and I think that this is one of the biggest things that I feel like everyone should know if you're self-employed. Make sure you work with a good CPA.
Absolutely.
And you want to make sure that you are doing your taxes correctly. And what I mean by correctly is it's very easy in today's age to write off as much as possible, especially if you own your own business, right? You're going to finagle it. You're going to do things legally, right?
Sure.
But I'm going to write off this, I'm going to write off that, where let's say you actually made 80 grand, but on your taxes you made 40. Try buying a house now. So because we have to use your tax returns if you're self-employed. And so we've run into it a lot where I've had clients in the past bring me their tax returns and their net income for the year was $0, right? But they actually made six figures. Yeah. And so they're like, well, what do I do? And there are things that you can use. There's these portfolio loans. You can use a bank statement loan. If you're in that scenario, talk to a loan officer. But what I really want to tell people is like, make sure you're doing your taxes correctly if you're self-employed, because it can really hinder. And if no one has ever told you that, how are you supposed to know? Right? You're thinking, I'm own my own business. I'm killing it, making six figures. And then you go to buy a house and it's like, you didn't fill out your taxes correctly, and now, now you're screwed. So I think kind of going down. We'll talk more there because there's a few more things with income. It's very important.
Yeah, absolutely. That's the thing. A lot of people want to know about that, like about income. And that sort of thing.
Like and how it impacts you buying a house.
Because one guy. I mean, this is a story, but one guy I ran into that I was working with, he had good credit, like really great credit. But then when it went time to qualify for the loan, I think it was a really low loan amount, which made it difficult to qualify for. But how important is income? I mean, he got qualified, but it was just a low amount. But how important is it?
I mean, it's the most important. I mean, besides your credit score, we can even finagle things more with your credit score. Like your income is key. I will say typically for conventional, you're going to need 2 years work history. Now, this can be confusing. That doesn't mean you need to be at your current job for 2 years. If you're a W-2'd employee, as long as you have had a job for a 2-year stint, you fulfill the work history requirement. Okay. Now, when does it affect you from like W-2? Let's say you're a W-2 paid employee and your salary, right? That's a slam dunk typically. Right. What can hinder you is if you switch to part-time. You go from full-time to part-time. Right. That can be a hindrance. Absolutely. If you're trying to get pre-approved the next day, right? The next piece is going to be if you go commission, right? You flip to commission pay, right? Now you need 2 years receipt.
You need 2 years of commission checks or whatever it could be.
Exactly. So, those are important to know. Hourly is typically fine. It's going to be more variable than a salary. But anything W-2, unless it's commission, because a lot of people can still be paid commission and be a W-2 employee.
What about waiters and waitresses and bartenders? And the food industry.
I mean that's going to be considered variable. We're going to need to average that as well. But typically, if you've been there for 12 months, typically there's not going to be an issue there. So, and there's always different products out there that can help you. If you don't qualify for a slam dunk conventional, ask what else is there out there. There's a lot of different products out there. So, but I think it is important to know, the more stable your income is, the easier it's going to be to qualify for where you want to be.
Right.
So yeah,
we were talking about a little earlier, where one spouse maybe has a really good income and maybe the other one has no credit or even bad credit, but they have like a down payment, or whatever the case may be. But they both want to get on the same loan.
Yeah.
Do you think it might be a good idea if one of them maybe isn't, but they still are on the same deed and they have ownership of the house?
Yeah, absolutely. I would say that's the most common. And the most common strategy is if there's one borrower, if there's going to be two borrowers on the loan and one just has really bad credit, that's kind of affected, because that's going to affect your credit score. It's going to affect
if you all share.
And so in any time frame, you can only have one person on the loan at that point. But the borrower two, the second person, we keep them off of the actual mortgage loan, but they can still be on the title and the deed and still own the house. So that is very common. It happens way more than you think. Because maybe there's a product that has a certain, we've run into it more with income limits, where it's I have two buyers and I want to put, you either don't use the person's income, or if they have a worse credit score, you just leave them off altogether. And it's really, at that point, it has to be okay with the buyers, right? And the borrowers, that they have to be okay with it. But are there strategies and techniques to leave one person on, one person off? Absolutely.
Yeah.
You've seen an uptick in the last 2 years of co-signers or non-owner occupied co-borrowers, where parents I may have told you, I had a dude recently, he's 22 years old, bought his second house.
Wow. At 22 years.
Yeah, his own business. So he didn't have 2 years of tax returns yet. So dad co-signs, he uses dad's income to qualify. And dad's on the loan for the time being. So there's always risk involved, but it's if the only thing holding you back is your income, or your credit score, there are definitely ways to finagle and figure out how do you make this happen? What's your why?
Your why?
Yeah.
Yep, absolutely. It's a huge deal. It's a huge deal.
Huge deal.
And I think it's important enough. But I think a lot of people, that's good to know. I think that's good to know, because to know that you could just have a co-signer. Oh, NASCAR.
Yeah. NASCAR.
Yeah. So, but you have to have a co-signer and be able to just use a family member, or someone who's generally some of the best advice I got coming out of school or whatever.
Yeah.
When I graduated, so it was a guy who was on the construction site with me, and this guy was 35 years old, and he said, James, when you get out, when you graduate, the only thing you should be focused on is getting a 1-story, 3-bed, 2-bath house to get yourself started.
Yeah.
And that'll kind of set you up. He said it'll maybe take $5,000. He said you can ask everyone around you that only thing you want, to group together and get $5,000, and that'll be your thing, and you just put that towards a home. Yep. And that was some of the best advice I ever got. Because after I got out, I ended up saving up money and all that, stayed at home and all.
Yeah.
Then went, and got a house months later. But that was really good advice, because looking back on it, it's
Yeah. How much equity have you gained since that guy told you that when you bought that house?
I'll cut this out. Probably.
Yeah. But yeah. I mean, it's incredible.
Yeah.
I think too, like it's good for people to know about gift funds. Like 1 in 2 loans probably end up having some sort of gift fund. And for conventional, as long as it comes from, it's got to be a spouse, a parent, a grandparent, a child.
A gift? What is that now?
So a gift fund. Yeah. So, I mean, it happens all the time where, you want to buy a house and like your parents have money set aside, like they can gift you the funds to cover all of closing costs and all of your down payment. So not everyone has that luxury.
Is there like a tax benefit to anyone?
What I always say is talk to your CPA. I'm not a tax.
Good advice.
That's awesome.
What do you normally do? Like, what does a normal day look like for you? Like, if you wake up in the morning, go in the office or?
Yeah, so I'm on baby duty in the morning.
Okay.
So I take my daughter to daycare, and then typically, I mean, I try and set up lunches most weeks.
Right.
Just people like yourself. Yeah. Like it's always good to connect with people in the industry or in similar fields just to like learn from. Like I feel like that's the best way to learn.
It's super valuable
is from talking to people. So, but yeah, I think I use a CRM, like a customer relationship tool, and so just kind of work in the pipeline. But a lot of times when I have quite a few loans under contract, it's a lot of times you're just tackling where they're at in the loan process. Like you might be calling to get homeowners insurance documents, or you might be locking people in for interest rate, sending out pre-approvals or quotes. So every day is completely different.
Seems really dynamic, and it's like you're working with different parts of the process with different people at all sorts of times.
Absolutely.
So it keeps you interested in like the day to day.
It really does.
I feel like real estate and mortgage are very similar careers. And,
absolutely. And they go hand in hand. And I mean, they're definitely similar in the time that you work 9 to 5, and then you also work every other time too.
Whatever time.
Literally. I mean, too. It's like you got to pick up the phone. Like when someone calls, like if you don't answer, they're going to call the next person. So
it's like,
it's huge. It's a huge aspect. So I mean, I say I work nights and weekends, but it's not like typically it's at home or wherever whatever I'm doing.
It's kind of a benefit though too.
Yeah, it's a huge benefit. Like I worked at Chick-fil-A for years, and I was like, man, I will trade being on my computer on Sunday night at 8 p.m. for being at Chick-fil-A at 5:30 in the morning on a Saturday.
Wow. Yeah.
All day.
Yeah. Because it's just like still, an odd time to be working, but when you're at home, kind of on your laptop, maybe on the couch, maybe next to your family, and you're still just walk out the room. And take a call.
It's great. It's a good fit.
But it probably took you a minute to get to that, point. Like in the beginning, it's definitely a grind. Like
and I still like it's just good for me to work in the office. So I really try and stay at the office. A loose 9 to 5, like
structure.
Yeah, it's good to have structure. But like you said, someone if you're sick one day or like
your kids
you want to go on vacation and take a Friday, like you'll still work, but having the flexibility to do those things is so great.
It's amazing,
in this industry. So
I ain't scared of you, mother.